One of the most frustrating experiences for consumers is noticing that prices go up quickly, but almost never seem to come back down. Whether it's groceries, rent, transportation, or everyday services, price increases often feel permanent. Even when inflation slows or economic conditions improve, prices usually stay elevated. So why does this happen? Why do prices rise easily but fall so rarely? To understand this, it helps to look at how pricing works in the real economy, not just in theory, but in practice. Inflation raises the floor, not just the speed. Inflation measures how fast prices are increasing, not whether they are high or low. When inflation rises, prices move upward. When inflation slows, prices don't reverse, they simply rise more slowly. This means inflation tends to raise the floor of prices across the economy. Once a new price level becomes normal, businesses, workers, and consumers begin to adapt to it. That new level becomes the starting point for future pricing decisions. As a result, prices rarely return to previous lows unless there is a significant economic shock. Businesses adjust prices to survive, not just to profit. Many people assume companies raise prices simply to increase profits. While profit matters, price increases are often driven by rising costs. During inflationary periods, businesses face higher expenses for wages, rent, energy, insurance, transportation, and raw materials. Once companies raise prices to cover these higher costs, lowering them later can be risky. Cutting prices may reduce revenue without reducing costs, especially if expenses remain elevated. From a business perspective, it is safer to maintain prices than to lower them and risk operating at a loss. Wages rarely move backward. Labor costs are one of the strongest reasons prices stay high. When wages increase, they almost never go down. Employers may slow future raises, but outright wage cuts are rare and often lead to morale problems, higher turnover, or labor shortages. Because wages are a permanent expense, businesses must set prices high enough to sustain payroll over time. Even if other costs stabilize, higher wages keep pressure on prices, making widespread price reductions unlikely. Consumer behavior reinforces higher prices. As uncomfortable as it may be, consumer behavior plays a major role in keeping prices elevated. Over time, people adjust to higher prices. They may complain, cut back in some areas, or switch brands, but if enough consumers continue buying, prices hold. When demand remains relatively stable, businesses have little incentive to lower prices. From their perspective, if customers are still purchasing goods and services, reducing prices would simply mean earning less without gaining additional sales. Price cuts can signal weakness. Lowering prices can send an unintended message. In many industries, price reductions are seen as a sign of trouble, declining demand, excess inventory, or financial stress. Companies often avoid price cuts to protect their brand image and market confidence. Instead of reducing prices, businesses may choose other strategies, such as shrinking package sizes, reducing features, limiting discounts, or slowing the pace of future increases. These approaches preserve price levels while quietly managing costs. Supply chains don't fully reset. Even when supply disruptions ease, supply chains rarely return to their old cost structures. New contracts, revised logistics routes, higher insurance premiums, and increased security costs tend to remain in place. Once these systems adjust upward, reversing them can take years, if it happens at all. These lingering costs continue to influence pricing long after the original disruption has passed. Housing and services are especially sticky. Some prices are more sticky than others, meaning they are slow to change downward. Housing is a prime example. Rent increases tend to persist because landlords adjust prices gradually and rarely reduce them unless vacancy rates rise significantly. Services such as healthcare, education, childcare, and repairs also resist price declines. These sectors rely heavily on labor, and since wages rarely fall, service prices tend to move in only one direction. Deflation is rare and risky. For prices to broadly fall, an economy would need to experience deflation. While falling prices may sound appealing, deflation often comes with serious economic problems, including lower spending, reduced investment, and rising unemployment. Because of these risks, governments and central banks work to prevent deflation. Economic policies are generally designed to stabilize prices rather than push them downward, which further reduces the likelihood of widespread price declines. Averages hide individual experiences. Inflation statistics reflect overall trends, not personal spending habits. Some prices may fall, while others keep rising. If the items people spend the most on,